Does the 10-year Treasury yield hold the leash of the stock market? Well, we saw that yesterday. Right now, we do have that yield off the highs of yesterday. We're at 2.92%, kind of inching toward 3%. But according to Peter Schiff, it may blow the top off that and even touch 4% this year, possibly even higher. And that concerns him. And he says it should concern you. He's Euro Pacific Capital president. Peter, there are a lot of people whose eyes start to glaze over when they hear about the 10-year yield. Why does that somehow present a harbinger of horrible things to come?
And it's not just the 10-year, go all the way out to the 30-year. Rates are going a lot higher. You have to remember the way the Federal Reserve was able to prop up the market and prop up this economy was by keeping interest rates artificially low. And they've succeeded in doing that for a long time. But now the markets are going to raise interest rates back to where they should be. And they should be a lot higher because we have record debt, record budget deficits coming, record trade deficits, a 10-year low in our savings rate. We have to borrow tremendous amounts of money, and the world is not going to lend it to us at these ridiculously low interest rates. So
I just want to show a long-term. Let me show a long-term 10-year yield going back, let's say, 10 years. And you can see where it was 10 years ago, and then you can see where it is now, and it's kind of heading back to what we saw. It's even higher than where we were in 2008. So that would make sense, wouldn't it? What does this number engender so much fear?
It's going to go higher. Look, we have more than twice the debt that we had in 2008. And you remember when we were doing trillion-dollar deficits under Obama, the Fed was doing $1 trillion a year in QE. So now the Fed is doing no QE, and the Fed is actually threatening to shrink its balance sheet, which means the Treasury is going to have to sell extra bonds to pay off the Fed. So the amount of debt that we're going to be selling is unprecedented. So supply is going off the charts. So rates have to go up. And the markets don't understand exactly how high rates are going to go.
Make us
and how
understand
quickly they're going to get there.
How bad could it eventually get? Well, let's look at the debt clock. We know that the debt has gone up and could possibly hit a full $21 trillion this year. And listen, the president did criticize the national debt, I recall, when he was running, and yet now it's gotten even higher. I think it's adding something like $45 per second.
Well, he criticized a lot of things rightly when he was running, but now he's embracing everything he criticized, including the big, fat, ugly stock market bubble. You know, and I believe that bubble popped. I believe that we're now in a bear market. It's not a correction unless the Fed decides to blow more air into it, which is still what I believe is going to happen. But,
more
you know,
QE?
you're talking about all this. Yeah, QE4 is coming. But if you think that the economy is going to grow at 3%, which I doubt, right? I think it's going to be hard to even hit 2%. But if it does 3%, that's the real rate. Then the nominal rate would have to be 5%. If you think inflation is just 2%, that would imply a 10-year yield of at least 5%.
But
that's in normal times.
Let me speak for what, if President Trump were here, he would say the tax cut will pay for itself, the $1.5 trillion, and it will stimulate the economy. I still don't understand, though, why suddenly they're predicting 2 to 4% growth, and yet if you look at the Atlanta Fed, they're really scaling back their prediction. I believe just a few days ago, at the beginning of February, they pretty much had it at 5.4% February 1st, and then by February 16th, it's now 3.2%.
Yeah, and they're going a lot lower than that.
See?
I mean, that's already I don't know what they were smoking when they put up 5.4, but at least now they're thinking a little more clearly. But they're still too high. This is going to be a limbo. They're going to keep lowering that bar as we get closer and closer to the numbers.
What are you doing at Euro Pacific to help your clients?
Well, look, I believe that the end game is QE4. I think the Fed is going to sacrifice the dollar to prop up the stock market, to try to prop up the economy.
So are you shorting the dollar? What are you doing?
Well, yeah, well, of course. I mean, the dollar now, it's on its pace for its worst year in 30 years. Last year was the biggest drop in 14. I'm buying foreign stocks. I'm buying commodity stocks. I'm buying gold stocks. All this is bullish for gold and bearish for the dollar. You know, nobody can figure out. The mainstream is scratching their heads. They don't know why yields are rising and the dollar is falling. It's because of a loss of confidence in the Fed. It's because of rising inflation. Rates are not rising for the right reason. They're rising for the wrong reason. And Trump is wrong. You don't stimulate the economy by cutting taxes. You stimulate the economy by shrinking government.
And it is important to point out that you voted for President Trump, correct?
Well, you got to remember my choices, right? It was Trump or it was Hillary Clinton. I mean, so he wasn't my pick for the nominee. I was a Rand Paul supporter. But my point that I'm trying to make, Liz, is that you stimulate the economy by making government smaller. So government takes away fewer resources.
So we have to work with the landscape we have ahead of us, and you have to tell our viewers right now the number one thing they should do with their portfolio.
They should send it to me to manage at Euro Pacific Capital. They should get out. Yeah, you're laughing.
Short of that.
No, they got to get out of the U.S. stock market, get out of the U.S. bond market, get out of the U.S. dollar, and there's a lot of places that you can go. There are other countries that are not as reckless and not as irresponsible. They have fewer regulations, lower taxes, trade surpluses, but governments that live within their means, and you got to get into some gold stocks. Gold is going to go ballistic when the markets figure out what I already know.